Thousands of Kenyans are rushing into the stock market through platforms like ZD Trader and the virtual trader by the Nairobi Securities Exchange, and some are making excellent returns. For instance, last month in June, the Nairobi Securities Exchange announced that investors got 27.8% from their investment in listed equities, which outperformed other major investment options. But many other Kenyans are losing money almost immediately, not because shares are a bad investment, but because they make simple mistakes before buying their first share or when executing their trades. So if you're planning to invest in companies like Safaricom, KCB Equity, Co-operative Bank, or any other company listed on the Nairobi Securities Exchange, don't buy anything until you have watched this video. In the next few minutes, I will show you what you need to know before buying your first share and the mistakes you need to avoid. And if it's your first time in this channel, please hit the subscribe button and also like this video. It really helps us a lot. So let's get started. The first thing you need is to understand what you're investing in. Remember the number one rule of investment. Don't invest in something you don't know or you don't fully understand. So before you invest or put your money into the stock market, invest time to learn about financial markets, and this is critical, especially if you are investing large amounts of money. You have to understand basic information like what is stock market, what is a share, how to make profits, how to conduct fundamental and technical analysis, risks involved, and how to manage those risks, and other important information about the stock market. Don't jump into the ship just because you heard people are investing in the stock market without even understanding what you are actually buying. Buying shares doesn't mean you're simply purchasing a number on a screen. You are actually buying a small ownership stake in a real business. If the company performs well over time, your investment may increase in value. That's how you make money on your investment. But if the company struggles, your investment can lose value. This is where you lose your money. So don't venture into stock markets, either locally or even globally, without understanding the market or understanding the whole concept of the stock market. And there are different ways to learn. Read books, take online courses, follow credible financial experts. Nowadays financial experts are openly and freely sharing information about stock market on social media platforms like Facebook, Instagram, and TikTok, and even YouTube. But you have to make sure you follow those experts who share authentic information or advice. Don't just follow anyone who is creating content. The more knowledge you have, the fewer expensive mistakes you make. The second thing that you need to set clear investment goals. Before buying your first share, ask yourself, why am I investing? For retirement, or to build wealth, or to generate dividend income, or to pay for your children's education? Having a clear goal helps you stay disciplined when markets become volatile. And when you are setting your goals, think long term. The people who usually succeed in the stock market aren't those who constantly buy and sell. They are the ones who invest consistently and remain patient. Always think in years, not weeks, not days. Like you can invest for university education for your children, or for your retirement, or to build wealth. And building wealth takes time. You can make small monthly investments which can grow significantly through compounding. And Remember, time in the market is usually more important than trying to perfectly time the market. Another thing you need to know is you should not invest your emergency fund or money that you'll need soon. One of the biggest mistakes new investors or beginners make is investing their emergency money. Once you buy shares, the price can go up or go down. Sometimes it's stuck in a position for weeks or months. Now, if you invest your money that you need to pay school fees or rent or emergencies, and unfortunately the market goes against you, you might be forced to sell at a loss. So only invest money you can comfortably leave untouched for several years or several months. Another one is that you need to buy shares for a company or companies that you know. That means you must research the companies or the company that you are interested. Never buy shares simply because someone on WhatsApp, TikTok, YouTube, or your friend says they are going up. Instead, ask these questions. How does the company make money? Has it been profitable over the last several years? Is revenue growing, or does it pay dividends? Does it have too much debt? Is management trustworthy? And the better you understand the business, the more confident you will be during markets up or downs. So the next thing you need to understand the risks. Many people think shares only go up, but that's not the case. Share prices can fall because of different factors like economic slowdown, poor company performance, political uncertainty, like now we are about to get into 2027, the election year in Kenya, which may cause the market to go down. Then we have factors like interest rates, global events like the wars in Ukraine, in Iran, and even investors panic. So short-term losses can happen, and as a good investor, you must accept that short-term losses can happen. And your goal is long-term wealth creation, not quick profit. So that's the best way to manage risks, or knowing those risks or understanding the risk helps you to be prepared and to avoid panic selling. Another one, diversify your investments. Never put all your money into one company. Imagine investing every shilling in a single stock. If that company performs badly, your entire investment suffers. Instead, spread your money across different sectors. For example, you can buy some shares for a company in the banking sector, then another company in the telecommunication sector, manufacturing, insurance, or energy. Like you can invest in Safaricom, then KCB, or Equity Bank, or KPLC. Diversification helps reduce risk, and with this strategy, you can avoid big losses when the market goes down. Remember, don't put all your eggs in one basket. So the next one, you need to know the costs involved. Buying shares isn't completely free. There are transaction charges, broker commissions, regulatory fees, taxes in some situations, and these costs may seem small, but they can reduce your overall returns. Before investing, understand exactly what you will pay, and this may help to control your expectations. Last one, you have to understand that dividends are not always guaranteed. Many beginners buy shares because a company has paid dividends in the past. But remember, past dividends does not guarantee future dividends. Companies only pay dividends if they make enough profits and if the board decides to distribute those profits. Focus on buying strong companies, not simply chasing high dividends. So to conclude, before buying shares in Kenya, you have to remember these things. First, you need to understand what you are investing in. Don't jump into this ship because you heard people or those who you know investing in the stock market. Second one, have clear financial goals. Third one, only invest money you won't need soon, not your emergency fund. And the fourth one, research the company or the companies you want to invest thoroughly. Next one, understand the risks and also diversify your investments. Know the costs involved. Don't rely on dividends. Think long term. Keep learning. And remember, the stock market isn't a get rich quick scheme. It's a powerful tool for building wealth, but only if you invest wisely and patiently. If you found this video helpful, give it a thumbs up and subscribe to the channel for more practical personal finance and investing tips. Thanks for watching, and I will see you in the next video.